In global economics, the most dangerous moments are rarely loud. They don't begin with alarms, they don't arrive with emergency press conferences, and they almost never start with markets collapsing overnight. Instead, they begin quietly inside regulatory systems, legal frameworks, and technical rules that most people never pay attention to. Right now, one such mechanism is being discussed at the highest levels of U.S. trade and regulatory policy. It doesn't look dramatic, it doesn't sound aggressive, but if activated, it could place $2.4 trillion worth of trade between the United States and Canada into immediate uncertainty. Most people assume trade wars are fought with tariffs, numbers announced on television, percentages added to prices. But modern trade power works very differently. Today, economic leverage often hides inside certification systems, compliance rules, and approvals that entire industries depend on to function. These systems decide what can legally move across borders and what cannot. Airplanes, industrial parts, logistics networks, supply chains that support millions of jobs. If one link inside that system pauses or tightens, the effects don't show up instantly. They move quietly through pricing, availability, delays, and eventually consumer costs. This is not about political theater. This is about how economic control actually operates in 2026. And the reason this moment matters is simple. Once these systems are used as leverage, reversing the damage becomes slow, complicated, and expensive, even if no official trade war is ever declared. The question isn't whether markets will notice, it's how long it will take before the consequences become impossible to ignore. To understand why this situation carries real weight, you first have to understand the scale and structure of trade between the United States and Canada. Canada is not just another trading partner. It is America's largest export destination and one of its most deeply integrated economic counterparts. Every single day, goods worth billions of dollars move back and forth across the U.S.-Canada border. Not just finished products, but components, materials, and intermediate goods that industries rely on to operate. Unlike overseas trade, U.S.-Canada commerce functions as a shared production system. A single aircraft may involve parts manufactured in Canada, assembly in the United States, certification under joint regulatory standards, and maintenance and servicing across both countries. This integration exists across aviation, automotive manufacturing, energy infrastructure, agriculture, and defense supply chains. Because of this, the system is efficient, but also highly sensitive. When trade relies on shared standards, certifications, and approvals, disruption doesn't require tariffs. It only requires friction. A delay in certification, a compliance review, a regulatory pause. In industries like aviation, certification is not optional. Without approval from U.S. regulators, aircraft parts or services cannot legally operate in American airspace. That authority gives regulators enormous influence, not just over companies, but over entire supply chains. This is where concern begins to grow, because when regulatory mechanisms become tools of pressure even temporarily, the ripple effects extend far beyond the companies directly involved. Airlines face operational uncertainty, manufacturers delay production, suppliers face contract risks, investors begin recalculating exposure. And importantly, none of this needs to happen loudly. There's no immediate crash, no instant shortage, just a gradual tightening that quietly raises costs and slows movement. That is why economists and trade analysts are paying close attention now, not to headlines, but to the systems underneath them. Because once uncertainty enters a tightly integrated trade relationship, confidence erodes first and consequences follow later. When people hear the word trade pressure, they usually imagine tariffs, taxes added at the border that raise prices overnight. But in modern global trade, tariffs are often the least precise tool. The real leverage sits elsewhere. In industries that involve safety, technology, or national infrastructure, governments control something far more powerful than taxes: certification and authorization. Take aviation as an example because it reveals the mechanism clearly. Every commercial aircraft, every major component, and every critical system must be certified by regulators before it can legally operate. In the United States, this authority rests primarily with agencies like the Federal Aviation Administration. Without certification, aircraft cannot fly in U.S. airspace, regardless of who built them or how safe they might actually be. This creates a quiet but absolute gatekeeping role. Now consider how deeply U.S. and Canadian aviation systems are intertwined. Aircraft manufacturing, maintenance, and parts production operate across borders. Certifications are often recognized mutually, creating efficiency but also dependence. If that recognition is questioned, reviewed, delayed, or narrowed even temporarily, the impact is immediate at the operational level. Airlines cannot take delivery of aircraft, maintenance schedules are disrupted, parts shipments slow or stop, insurance and liability concerns multiply. None of this requires an official ban. All it takes is procedural friction. And this is why trade analysts are paying attention, because when certification systems become part of broader economic or political disputes, the effects move faster than markets can price in. Companies don't wait for official announcements. They delay orders, they freeze investment, they build contingency plans that cost money. And those costs don't disappear, they move downstream. Higher operational costs eventually show up in ticket prices. Delays affect cargo timelines, manufacturers renegotiate contracts, suppliers reduce hiring or cut capacity. From the outside, everything still looks normal, but inside the system, the gears are grinding. That's the risk when regulatory tools cross the line from safety oversight into strategic leverage, even unintentionally. One of the most misunderstood aspects of modern economic disruption is how quickly it escapes its original context. This situation is often framed as a government-to-government issue, a dispute between Washington and Ottawa, regulators and policymakers. But in reality, the economic consequences don't stay at that level for long. They move through businesses, workers, and consumers. Start with airlines. Airlines operate on thin margins and strict schedules. Aircraft deliveries are planned years in advance. Maintenance cycles are optimized to reduce downtime. Any uncertainty around certification or cross-border servicing immediately forces airlines to make conservative decisions. They delay expansion, they ground aircraft longer than planned, they reduce route capacity. That feeds directly into pricing. Next come manufacturers and suppliers. Aviation supply chains rely on predictability. When approvals or standards become uncertain, companies stockpile parts, seek alternative suppliers, or slow production to manage risk. That increases costs across the board. Small and mid-sized suppliers are hit first. These companies don't have the balance sheets to absorb long delays or regulatory uncertainty. Layoffs don't come from headlines, they come from spreadsheets. Then come investors. Markets don't react only to events, they react to risk. When analysts begin pricing uncertainty into future earnings, valuations adjust. Capital moves away from exposed sectors. Financing becomes more expensive. And finally, consumers feel it, often without realizing why. Higher ticket prices, slower shipping, increased costs embedded in everyday goods. No single moment feels catastrophic. There's no single day when everything breaks. Instead, the system slowly tightens, and people begin asking the same question. When did everything get more expensive? This is why economists say that modern economic pressure works less like a hammer and more like a vice. It tightens gradually, quietly, relentlessly. And once confidence erodes, restoring it takes far longer than breaking it. Financial markets rarely wait for confirmation. They move on signals. Long before any official policy is enacted, markets begin pricing in probabilities, not outcomes. That's what makes situations like this especially sensitive. Even the possibility of regulatory friction can change how capital flows. When analysts observe uncertainty around certification, trade rules, or cross-border approvals, they don't ask whether disruption will happen. They ask how expensive it could become if it does. That distinction matters. Institutional investors such as pension funds, asset managers, and insurance firms are heavily exposed to transportation, logistics, aerospace manufacturing, and industrial suppliers. These sectors depend on stability, predictability, and regulatory continuity. Once those assumptions weaken, exposure is reassessed. Capital becomes cautious. Instead of expanding positions, investors hedge. Instead of financing long-term projects, lenders shorten time horizons. Credit terms tighten, risk premiums increase. None of this is visible on the evening news, but it shows up quietly in earnings calls, financing costs, and revised forecasts. For publicly traded companies, even a small increase in perceived risk can lead to lower forward guidance, reduced capital spending, share price volatility, and delayed hiring or expansion. And because U.S.-Canada trade is so deeply integrated, this risk is not isolated to one country's balance sheet. It becomes systemic. Currency markets also pay attention. Trade uncertainty affects expectations around exports, growth, and interest rate policy. If markets believe trade friction will slow economic activity, they begin adjusting currency positions accordingly. That influences import prices, inflation expectations, and central bank decision-making. In other words, what begins as a technical regulatory question can evolve into a financial narrative, one that affects how money moves across borders. And once markets adopt a narrative, reversing it takes far more than reassurance. It requires clarity, consistency, and time. The most damaging effects of trade uncertainty are not immediate, they accumulate. When companies operate in an environment where rules feel unstable, even if nothing has technically changed, decision-making shifts. Executives prioritize risk avoidance over growth. Innovation slows. Expansion plans are postponed. This is how structural damage forms. Businesses begin diversifying supply chains away from efficiency toward redundancy. That may sound responsible, but redundancy is expensive. It raises operating costs permanently. Once companies invest in alternative suppliers, new logistics routes, or parallel certification processes, they rarely reverse those decisions, even if the original issue is resolved. That means higher baseline costs going forward. For workers, this translates into fewer new jobs, slower wage growth, and reduced investment in training. Not because companies want to cut back, but because uncertainty makes long-term planning dangerous. Governments also face consequences. Lower business investment reduces tax revenue. Slower growth complicates fiscal planning. Pressure increases on policymakers to stimulate demand, often through debt. And this is where the ripple effect becomes generational. What begins as a regulatory dispute can quietly reshape how entire industries structure themselves for years to come. The cost isn't measured in headlines, but in lost efficiency, missed opportunity, and reduced competitiveness. Economists often describe this as confidence decay. Once trust in a stable framework weakens, rebuilding it is slow and fragile. Even after clarity returns, businesses remain cautious because they've learned how quickly rules can shift. This is why trade relationships built on shared systems are both powerful and vulnerable. When they work, they create immense value. When they fracture even slightly, the damage lingers. And this is the point most people miss. The greatest cost of uncertainty is not disruption, it's hesitation. When systems like this enter a period of uncertainty, the most important variable is not speed, it is duration. Short disruptions can be absorbed. Prolonged ambiguity cannot. If regulatory tension continues without clear resolution, industries begin adapting in ways that are rational individually but damaging collectively. The first change is behavioral. Companies stop assuming stability. Instead of asking, how do we grow within this system, they begin asking, how do we protect ourselves from this system? That shift alters long-term strategy. Manufacturers may accelerate plans to localize production, not because it's cheaper, but because it's safer. Airlines may diversify fleets or maintenance contracts to avoid overdependence on any single regulatory pathway. Suppliers may seek certifications in multiple jurisdictions, increasing overhead and compliance costs. Each decision makes sense on its own. Together, they fragment efficiency. Trade relationships that once functioned like a single integrated engine begin operating like loosely connected parts. Friction increases, costs rise, flexibility declines. At the policy level, prolonged uncertainty also changes negotiating dynamics. When regulatory tools are perceived as leverage, trust erodes. Future agreements become more complex, slower, and less ambitious. Safeguards multiply. Cooperation gives way to caution. This has long-term consequences. The U.S.-Canada economic relationship has historically been one of the most stable and predictable in the world. That stability has been a competitive advantage, attracting investment, lowering costs, and supporting millions of jobs on both sides of the border. When that predictability weakens, even slightly, it alters global perceptions. International investors compare regions. Companies decide where to expand. Capital chooses environments where rules feel durable. If uncertainty persists, the cost is not a single disrupted deal. It is a gradual loss of momentum. and momentum, once lost, is difficult to recover. At first glance, this story appears technical: certification standards, regulatory authority, trade compliance. But beneath those details lies a much larger question about how modern economic power is exercised, and how fragile even the strongest systems can be when confidence fades. In today's global economy, control does not always come from confrontation. More often, it comes from architecture, the rules, systems, and approvals that allow commerce to function. When those systems are stable, trade flows smoothly and quietly. When they are questioned, the effects spread far beyond the initial decision. That is what makes this moment significant. It reveals how interconnected modern economies truly are and how easily pressure can travel through channels most people never see. It shows that economic risk is no longer confined to borders or balance sheets. It moves through trust, expectations, and institutional reliability. For businesses, this is a reminder that efficiency without resilience carries hidden costs. For governments, it underscores the responsibility that comes with regulatory power. For consumers, it explains why economic changes often feel sudden, even when they have been building quietly for months. This is not a story about collapse, it is a story about friction. And friction, applied slowly and consistently, can reshape systems just as profoundly as shock. Understanding these mechanisms matters, not because they are dramatic, but because they define how the next decade of trade, investment, and growth will unfold. The world is not becoming less connected. It is becoming more sensitive. And in that environment, even small shifts can carry outsized consequences. When you step back and look at the full picture, one thing becomes clear. This story was never about a single policy, a single country, or a single moment. It's about how modern economies actually function and how fragile they become when certainty is replaced by ambiguity. For decades, the strength of North American trade came from something simple: reliability. Businesses planned years ahead because they trusted the rules would remain consistent. Investors allocated capital because they believed regulatory systems would stay predictable. Workers built careers inside industries that depended on that stability. What we're seeing now is not a breakdown, but a stress test, a test of whether integrated economic systems can withstand pressure when technical mechanisms are used strategically, even subtly. A test of how markets respond when risk enters places that were once considered safe by default. And most importantly, a test of how quickly confidence can shift when the foundations of cooperation are questioned. None of this guarantees disruption, but it does explain why analysts, companies, and policymakers are watching closely, often without saying much publicly. Because in economics, the most important signals are rarely the loudest ones. They are the quiet adjustments, delayed decisions, revised forecasts, cautious language, and capital waiting on the sidelines. Those signals tell us more about the future than headlines ever will. For viewers, the real value lies in understanding these mechanisms early, before their effects become obvious. Not to panic, but to recognize patterns. To understand why prices change, why markets hesitate, and why economic narratives shift seemingly overnight. This is how complex systems move. Slowly at first, then all at once. If you want to stay ahead of these shifts through clear, research-driven analysis, that's exactly what this channel is here to do. Because the world doesn't need more noise, it needs better understanding. If this breakdown helped you see the bigger picture, consider subscribing, not for alerts but for context. And if there's a part of this system you want explored next, leave it in the comments. That's where the next story often begins.